The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service, Become a Pro course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
Let's move on then to assessing discipline. So here we have the US dollar CAD, one of our favorite markets to discuss during this Become a Pro lesson. Okay, we have a technical level of support. What do we do? Well, okay, here's an entry price that we've chosen to purchase the market at. So we're going long this market. Okay, we've got a fantastic trade to the upside. They're at 0.1. And we're effectively bouncing off this first level. We've caught a breakout trade. Of course, this is the first time it breaks. So that's great. So we place our stop loss with assertive risk management. Again, it seems to be already more than a one-to-one risk, so a positive risk-reward ratio that we're operating on. And we follow the level of support. Okay, so perhaps we exited in and around profitable levels. And again, I'll just annotate this on our chart. Perhaps we exited here. Perhaps we decided to keep in the trade. It just depends. Okay. So next then, of course, as the market moves, we see more price action trading. Well, we come to the support level again. We observe price action, and we have decided to go long again and trade again for a profitable trade. But the market bounces again off such a level, and we take profit. And again, we make yet another trade decision and yet another trade decision again. So this seems to be a great trade. It seems to be working quite constructively for us. Okay. So the question is, just at this level here, we have just had 4 winning trades at the same entry price. What are we likely to do next? Okay. What are we likely to do next? So I would assume then, since we had trade 1 there and we took profit, say, well, we placed our stop loss there and we took profit. So that's great. So if we make trade 2 again, we are going to, of course, place the stop loss in the same level. And evidently, it seems to be a profitable trade the whole way through to trade 3 and 4. Again, as the market moves, then what do we do next? Or what are we likely to do next, just as human instinct? Well, of course, we buy the market. We buy the market there just as we see. Can a moment of greed, and the question I would like to pose, can a moment of greed affect your trading? Okay. Now, why am I asking such a question at this point in time? Well, because we've had 4 winners in a row, 4 profitable trades. Perhaps we're a little greedy. Perhaps we're not observing the technical support level as such. Perhaps we are not observing the price action and we're just being greedy. We're just ignoring what the market is telling us. You can simply see as the market trades to the downside right here, well, there's no buy signal. You can see the bounce here with the green candlesticks. You can see the level of rejection at this candlestick here. And again here, just off the level. Here it's trading down with bearish candlestick after bearish candlestick, yet we choose to ignore it. Okay. So there's a level of greed to this trade that affects and filters into a totally natural feeling of greed and discipline. Does that affect your discipline? So let's move on then. We decide to move our stop loss again, totally hypothetical. We've bought the trade, the market moves down, we've moved our stop loss. How are our emotions feeling? How are we feeling at this point in time? We've just had 4 free money trades. Evidently, we've caught the 5th trade that has moved to the downside. Okay, so, we haven't taken a loser yet because we've moved our stop loss, so it's fine. Well, effectively, the buy trade continues. We buy the market again. Again, this is terrible discipline. This is called averaging in, guys, and I'm just choosing this example to exploit the idea of how poor discipline can effectively be so damaging. And we choose to buy the market yet again. The market trades to the downside. Oh no, we're buying the market that is moving against us until inevitably we take a whopping loser. Okay, a terrible loser. We are willing the market to come back. Please come back. We've decided to get a better average price by buying the market again. And effectively, we have a terrible loser here at the end. Again, the question is, it's still free money. How are we feeling? How are our emotions feeling at this point? Okay, so a really, really tough example to walk through. And obviously, just to really exploit the level or the lack of discipline that some participants actually have trading these markets. That might shock a lot of you guys, but this is common practice for some retail traders, of course, and not something that we would ever recommend. Okay, so we've dealt with discipline. Now let's move on to patience. Of course, that's a strong example to present discipline, but that's how important it is, you know. So let's move on to patience then. As traders, we recognize that certain market conditions are simply better to trade in. So does everyone agree with that? Could I just ask the class if everyone agrees with that statement? Philip says yes. Matthew says yes. Peter says yes. Yolanda says yes. Okay, unanimously we have a lot of yeses coming in there. Great. Okay, absolutely that is the case. Markets are sometimes choppy and can trade sideways, providing difficult conditions in which to formulate trading strategy. Now, there are times, of course, when choppy markets can start to consolidate. They can trade in ranges. We call them trading ranges. And we can buy and sell the high and lows of these ranges. Of course, that's opportunity. But there are other trades or other markets that just simply show volatility and will spike you out of trades in every direction, giving you whipsaw action, are not the best trading conditions. And of course, if you're looking to formulate a trend trading strategy, well, that's not going to comply at all with your strategy. It is absolutely fine, in fact, common practice for traders to exercise some patience and simply wait out times when conditions are not great for trading. Okay, so we simply choose to wait out some of these conditions. This avoids getting caught up in the chop when the markets are not really deciding to show any price direction. Showing some patience will help the trader to improve overall trading quality. And again, it's better to have 4 high qualitative trades over a period of a week perhaps than 40 very poor qualitative trades that you're just getting involved and hoping to make a return. So then accuracy, how do we develop our accuracy? Developing a more constructive entry process will focus on deciding exactly when to enter the markets, okay? Being very accurate with trade and position sizing is just as important. So how much risk do you take will, of course, develop a level of objectivity to your entry price. The use of technical analysis can support decision making, but it is just not as important to know when indicators are providing accurate signals or not. And again, as we go through these Become a Pro lessons, that's going to be great in terms of defining your level of usage and experience with technical indicators. Some provide very false signals, and knowing when they aren't giving you the best signals is crucial to your entry price or even getting into some trades, of course. Accuracy in exit strategy will help traders to book in more profit rather than simply holding on to profitable positions with flawed expectations. So that is more often the case. And it's great to run winners, guys, okay? It's always great to run winners, but always react to what the market is telling you. If the market moves up and shows you $100, the next day shows you 105, the next day $106, the next day $70 profit, well, you're going to feel a level of frustration. The next day is $90, the next day $55 profit. You're going to feel really, really frustrated there, guys. So start to mitigate risk off trade, start to book in profit, start to align your own expectations with the trade to what the market is actually doing, to develop a consistent approach to, well, the market is giving me this type of winner, I'm happy with that, let's move on. Okay, let's then discuss attitude and knowledge of a trader. Again, this will bring us to a real structured approach. A directional bias and personal bias, dissemination of information, confidence in decision making, and realistic expectations and realizing profits. Okay, so this is all very contextual for our own knowledge, our own attitude of a trader that will start to build up over time. Okay, how do we properly understand data? How do we disseminate that data and trade over different time periods? How do we not confuse our own directional bias or an individual directional bias with a personal bias? Confidence, do we have a level of confidence not only in increasing the conviction status for a trade, whether it's a 1% trade or a 3% trade, or perhaps a 5% trade? Are we confident in all of those decisions? Are we confident traders, Confident traders, guys, are better traders. So let's start to develop our approach towards developing confidence as well. Realistic expectations and realizing profits. Okay, so let's have realistic expectations. Let's not hope that we make a trade and we have the next winning lottery ticket that is going to be the next correction in the Swiss currency from 120 to effective parity with the euro, that we're selling, hoping that will happen. That is once in a blue moon. Those market changes, of course, are fantastic if you capture the opportunity, but hoping that you're going to hit one of those trades is not going to be necessarily a trading strategy. And try and realize those profits when they come about. So let's delve into dealing with each of these points. So we have, first of all, proper dissemination of information. Guys, what does this mean, proper dissemination of information? It's your ability to realize, with the context of the market sentiment or environment, how the market is going to price in data flow. Both in the short term, now the market can misprice data as well. So this is a convoluted choice. It's quite difficult to assess, okay? And I'm going to walk you through an example here to non-farm payrolls, okay? And how the S&P 500 actually traded both in the short term and the long term, and how you can actually make opportunity trading different sides of the market, properly disseminating data both in the short term and long term, and really assessing what is happening with the market. Okay, so let's jump into this example. Non-farm payrolls, one of the most important economic data points of the month. For you guys, for some of you guys, I'm not sure if some of the traders here on board aren't sure what non-farm payrolls is. It's the monthly increase in jobs added to the US economy over the course of the month on month. Okay, how does the market disseminate this data is our question. Okay, and let's just consult the bottom right hand. We have Forex Factory, the economic data from the day, from the all days trading, and we'll look to trade off this day. Of course, we have in red, the red folders there describing the US data, average hourly earnings there month on month, non-farm employment change on unemployment rate. Okay, so how does the market price this data and how can we profit? Okay, so first of all, well, it's non-farm payrolls. It's the biggest figure of the month. Okay, the world looks towards the US economy as the largest economy in the world to see how it's progressing, to see how it's growing, and to see how that affects market, equity markets intrinsically across the world. So this is such an important figure that, of course, the market's going to anticipate and read this figure first of all. So the expectation here was 190,000 jobs added in the month. That was the forecast. Okay, in fact, the jobs added was 164,000. Okay, so that's actually what we call a beat in the markets. It's a market beat. It's less than expected. It shows less growth than expected in terms of the employment sector, okay, over the last month. So here we see, now these are 30-minute candlesticks here, S&P here with our M30, 30-minute candlesticks. We see the volatile candlestick showing the volatility. The market quickly prices this in with the shock figure just within the relevant hour. So it's a poor figure. Of course, the market trades down, and again, trades down quite strongly if we consult the relative price action leading up to the figure. Of course, it's quite small in terms of the average trading range for each candlestick. And again, we get volatile price action, whilst candlestick 2 here actually shows some negative volatility. So we could look to trade this in the short term as scalpers or over the 30-minute price action chart to sell this market. This is a sell trade, okay? And we can make profit to the downside. And it certainly closes on lows here with the close of the candlestick. However, what we can consult is that the market takes time to price in relevant news flow. I should say all relevant news flow. So non-farm payrolls, given its importance, of course, it was the first data point really to receive scrutiny, of course, and we see the market trade as such. However, we can see the unemployment rate here is a very important figure, and effectively the expectation was 4%, and the figure was 3.9%. So effectively now we don't have 4% unemployment in the US. We have 3.9% unemployment in the US. That is fantastic news for the overall growth story in the market. What you see with the price action is that the market properly disseminates and chooses to favor the 3.9% improvement in the overall growth story or employment data over the short term, month-on-month non-farm payrolls employment change. And we see the reversal candlestick closing above highs and continuing to show a price action trade to the upside. So again, if you're a simple long-term trader, well, this is a buy for you at these prices. Okay, this is if you have the ability to properly assess the overall story to what's happening in the US economy, and the employment sector of the economy, of course, as a huge contributor to GDP and overall growth, well, that is the trade for you. If you're a short-term speculator, you hear the figure come out, 164,000, as opposed to 190 expected, you're making the short trade on the short term. That's absolutely fine as well, but know and properly try to forecast what's going to happen in terms of the news flow released. Okay, so our ability to properly disseminate information is key, and that leads us to question, how we enter the markets in developing our own trading approach. Okay, and just to note, this is going to be of key context in later lessons through the Become a Pro course. We're going to really delve into how to properly disseminate proper news flow and information. Okay, so look forward to that. Okay, so let's move on then to our second point in terms of our knowledge and expertise: personal bias versus directional bias. Okay, now for the traders joining us, of course, today, is this the same thing? What do we think? Do we have just an overall level of bias in trading the markets? Some students are saying yes, others no. And I actually get the answer for both, because, well, of course, as humans, we have a level of bias towards a particular asset class or something that's moving quite strongly. If we can use a bubble to explain that, like Bitcoin or something there over the last 6 months, well, of course, we had a bias to get long when the price is rallying so much. It's just intrinsic in our nature. However, this is different, guys. Okay, so the discussion on trading bias has been well debated amongst financial traders. Many argue trading involves complete objectivity in decision making, whilst others actually promote bias mentality. Okay, so there is a debate among financial traders and analysts alike, but we need to define them. What we actually do is split them in half. We define them by both objectifying personal bias and directional bias, because they are different. And what we would say is personal bias is not recommended, as it tends to ignore how the market is actually trading. Analysts who put a lot of research into certain trades often become over-biased on their positions as a result. So again, someone who has studied a commodity like potentially a soft commodity like corn, and the forecast on yields for US as a huge producer of corn, is going to have knowledge, of course, but is going to have a level of bias potentially to that research, because they've put in 1 month or 2 months of research and they've crunched the numbers. Perhaps if you're pricing an equity that you think is undervalued, of course, you've crunched the numbers and you've really done a lot of data to research that pricing. Okay, so you're going to have a level of expertise, yes, but within your findings, you're going to have potentially a personal bias. So you might trade differently, whereas directional bias, on the other hand, will help the trader decide inevitably to become either a buyer or seller on entry. Okay, the management of this bias still assumes full objectivity. So let's see how that might be different. If we simply open up a chart and we can see a very strong structured trend to the upside. So now we have a very strong trend in the US dollar against the Swiss franc, because the Swiss franc is quite weak. The US dollar is quite strong, and it's trading, I believe it has roughly 13 to 14 trading days of bullish price action, albeit quite small, but very constructive trending indeed. Our directional bias is to buy that market, is to become a bull, of course, in that market. So that is a completely different approach actually to defining that to a personal bias that you may have across an asset class. Are we confident traders, guys? Confidence in decision making, how important is that? Well, I like to relate this to any activity, really. Think of any activity you've ever been good at, okay? Were you confident in your actions? Okay, and I would like to say that trading is absolutely no different. So I get some yeses, and of course that, look, for most of us, that's certainly the case. If you're perhaps good at football, you're a good soccer player or football player, of course. In the UK and Ireland, we call this football. You are potentially, training quite a lot. You're putting a lot of effort and time, a lot of practice, just like trading. You're gaining a level of practice to that. It's a passion of yours, of course. You believe that you have skills to play the game, of course, and that you have talent and that you're quite good. So that level of confidence is going to translate into performance, is it not? Of course, trading is actually very much alike. Okay, trading and a sport like that, or any sort of passion that you may have, has similarity in the fact that you're effectively, if you're more confident taking positions and taking risks in the market, you're going to assess those with confidence, those risks. You're going to trade much better and you're going to be more profitable. That is certainly the case. So I want to try and develop confidence throughout this Become a Pro course, guys, with active trading, with more analysis for asset classes. Feel free to ask questions, get involved, to build your expertise across these different markets that you like to trade, understand the risks involved. You will be more confident towards the end of this course and be a better trader. That is the case. Okay, so what do we define as confidence in trading? Well, confidence in your trading analysis, confidence in placing the trade is so important. So we call this, of course, more commonly known as pulling the trigger. Guys, if you don't have confidence to enter with a live trading account and effectively pull the trigger across some Forex pairs and get involved to make money, to put 20 euros on the line to make 40 euros, you're never going to be able to make it then. That's just the case, and I'm being quite frank there. I do apologize, but that is the case because it's a competitive environment. So have the confidence to back yourself and to pull the trigger, and confidence in taking losers, of course. That might sound silly, but confidence in taking losers is key because you believe that you may have traded a fantastic market. You put your analysis in there, but if you're wrong, take the confidence there on board to just take the loser and move on. Okay. Realistic expectations and realizing profits. Okay. So our final point then, markets are sometimes choppy and can trade sideways, providing difficult conditions in which to formulate trading strategy. Okay. It is absolutely fine. In fact, it is common practice for traders to exercise some patience and wait out times when conditions. So I did discuss this just there with patience, of course, as an exercise, but I want to gauge your level of understanding of patience with your expectation and realizing profits. So we are repeating our lesson on patience there, but let us discuss it practically. So trade number one, we've entered on the long here, just at the touch of this candlestick here. I'm going to take this just for you on the chart for those who may not be able to see. Just right here, we've entered a buy or long position is just right with the buy signal here. What do we see? Well, we see the market move up. It shows us some profit. Then the market moves to the downside. So potentially this was our trade. Potentially it was a long-term trade, and we want higher profits up to around this point. However, we're not reacting to what the market is doing. We see the market completely reverse and show us 4 bearish candlesticks until effectively the market moves down into a negative territory position here. Okay, so perhaps our stop loss was below these lows. That may be the case. That's absolutely fine. But effectively, we're in a negative position here when we were in a profitable position, okay, at this level here. That effectively is poor risk management. Okay, from A to B, the fact that we were potentially 50 euros on side, or the market was with us 50 euros, and it's now, I would say, 35 euros to the downside. Effectively, the risk reward of the trade there is effectively 85 euros, that we've let the market pull back 85 euros. Okay, so it's not great risk management, and it can be more sort of across different asset classes if you prefer to trade like this. But again, you're just ignoring what's happening in the price action again. So because you've simply seen the Japanese candlesticks trade in such a way, I would advise you to be more assertive in following, what the market is telling you again. Okay, so again, we move through. If we're just being complicit in our long-term price objective, that's fine. That's certainly the case. We see the market trade up again here, and again trading down, and effectively this might be the more relative price action today. Where are we in terms of the overall profit level after all this trading, after all this quote unquote pain that we experienced the market pulling back from 50 to minus 35 and back up again to potentially plus 30 at this level, and then pulling back again to a profit level of effectively zero. So we went through all this experience for effectively no profit. We're yet to see if this is going to become a losing trade or a trade that is going to show some profit. But again, try and manage your expectation with realizing profits. Do you get the point with patience, of course, in not only trying to be patient for full execution of a trade, of course, but patient in realizing what the market is giving you. If it's not giving you your full 100 euros at this price, but it's giving you half, and then it's consistently showing you that the market will not move up, take profit when it is the best time, and you are fully able to take profit, of course, and potentially move on to a correlated asset class that is giving you the same risk reward, okay, and potentially a better entry trade. Again, let's consult the second trade here. This is something that is more inclined to be easier to trade, of course, and something that we could be much more subjective in trading, because we have yet again a long position. And it's a great long position because we know that we have tried to capture already a trend. The market's moving up, continues to move up right up to this point here, and effectively doesn't pull back. So what we could do is move our stop loss up with the market to last corrective lows here. As the market moves up here, we could choose to put a corrective low in here. And again, as the market moves up here, we could choose to put a corrective low here. And again, if we're still in this trade here, we can simply take profit because that is our profit objective. Perhaps it's 100 euro and we are very happy with that profit. That's great. Or perhaps we didn't expect this to show us so much profit so quickly. Do you get what I'm saying? So patience can be there to use to the fullest. What we could do is move our profit stop loss up to here. So if the market pulls back, we're effectively capturing 90 euros profit. But if the market shoots up in the next day to show something like this, well, we are outperforming even our own expectations here with a potential profit of course, 150 or more. And the market may continue to digress and drift up further. We're not privy to that just as yet. So you can see we have two different examples where one is very frustrating according to our decision-making skills and patience skills with realizing expectations, or how the market is trading in accordance to our own expectations, but our ability or inability to realize profits, okay, as opposed to a very easy setup with trade number two, where we didn't realize profits, we mitigated risk, we over exceeded our patience, our expectations on the trade, and it may, we effectively have a free trade for it to pull back and give us our 100 euro or 90 euro winner, but it can of course move to the upside again tomorrow and continue its trend to show more profit. So that is how we reactively, trade to how the market is trading, and how we look to be more objective when the market is moving with us, and of course using a little discretion as a professional trader or building a professional trading methodology to really assess what's happening, and using the skills and expertise that we know both on a fundamental and technical level to better manage our trade positions. Okay, so that brings us to the end of today's webinar, of course, with our lesson summary. Let us define then and conclude the lesson. Although we are not trading at an institutional level, we must still develop a professional approach to trading. Okay, so where we don't have access to HSBC and the skills that they have, potentially they have Bloomberg terminals and all of these hedge funds strategic approaches to trading, we have simply ourselves, and we can develop our own, foster our own successful professional approach. Okay, we define a style of trading in correspondence with our own individual appetite for risk. We will make trading adhere to our own expectations. So it was more similar to the last slide that we were going through, of course, defining a style of trading. Okay, that style of trading certainly suits me better than other traders. Of course, I like to take less risks, but make much more trades. Therefore, I need to adhere to my own level of expectations of performance. Consistency, discipline, and patience are crucial and must somehow manifest themselves in your personal trading strategy. So no matter your idea on your appetite for risk or your level of risk, or how many trades you'd like to take over the course of a week, day, or month. Of course, consistency, discipline, and patience will need to manifest themselves in some shape or form in your trading approach. And last but not least, financial trading is an ongoing pursuit of education and adaptability. And I don't mean education simply with Forex.Academy, although I've enjoyed, going through the first few lessons, of course. What I mean is, when you come to the end of the Become a Pro course, guys, you'll have a lot of knowledge there, but it's not enough. Stick with education. The markets are moving every day. Every news flow that, every new piece of information that enters the market is effectively new education for you to thrive off and to adapt to. And of course, I've been trading just under 15 years myself. This is something I'm applying all the time and proactively reacting to news and learning what's happening, the tech sector, learning what's happening, cryptocurrencies, and trying to adapt to make profit and get involved in these markets, of course. So that brings us to the end of today's Become a Pro lesson. Of course, webinar 2, we discussed building and developing your own professional trading methodology. It's going to serve you from day one when you're trying to foster a successful approach in interacting with these markets in terms of risk management, entry, and all of this necessary expertise that is involved in financial trading. What I'll do then is look forward to going through webinar 3 with you tomorrow. We'll be discussing effective market analysis. So from all of us here at Forex Academy, what I can do is thank you very much for joining us. We'll see you next time. Bye for now.